Hi friends, welcome to Kids 2 Grown-Ups Finance. Ever been short on cash and thought, maybe I'll just take a payday loan until my next paycheck? Sounds easy, right? But what if I told you that a $300 loan today could snowball into thousands of dollars of debt in just a year? Today we're breaking down why payday loans are a financial trap, who usually takes them, and how they silently drain your money. How payday loans work. The process is designed to be fast and easy, with minimal requirements, to start with. The loan amounts are typically small, from a few hundred to $1,000, and the repayment period is very short, usually about 2 weeks. Second, no credit check. A major selling point is that these loans don't require a credit check, making them accessible to people with bad credit. And last, they come with extremely high interest. This is the key to the trap. The average interest rate for a payday loan is 400% APR, annual percentage rate, far exceeding the typical 22% APR on a credit card. For example, a person who takes out a $1,000 loan would typically owe $1,150 in just 2 weeks. If they can't pay it back, the loan is rolled over and fees are added, causing the debt to compound. This can cause the amount owed to balloon to over $4,900 in a single year. Why they're a trap? Payday loans create a vicious cycle of debt. The high cost makes it nearly impossible for many borrowers to pay off the loan by their next payday. This forces them to take out another loan to pay off the first one, and the cycle continues. Who goes for payday loans? Payday loan companies often target people who are most financially vulnerable. The video notes that these loans are not just for one-time emergencies. They're frequently used to cover recurring expenses like rent and transportation. Other lot can be vulnerable individuals. Payday loan companies advertise to those with no emergency fund who are struggling to make ends meet. Young people. A 2018 survey revealed that nearly 40% of 18 to 21-year-olds had considered taking out a payday loan. Companies target this group on social media, promising easy, quick cash with no credit check. Advertisements also use emotional manipulation, dangling dreams of money flexing to convince people to take out a loan for non-essential things like a vacation. Example, how it works. Let's say you borrow $500. In 2 weeks, you owe $575. The $500 plus $75 fee. If you don't have $575, you roll it over to the next payday. Another 2 weeks later, you owe $650 plus. If this keeps happening for a year, that same $500 loan can cost you more than $2,000 in fees and interest. Now let's see why people get stuck. People take the loan to fix an urgent need, but when payday comes, they don't have enough to cover both the loan repayment plus living expenses. So they roll over again and again. That's how the debt spiral starts. Is there ever a good time to take one? Honestly, almost never. Payday loans are like financial quicksand. They should only be a last resort for life and death emergencies. Even then, exploring alternatives like line of credit, credit card cash advance, or asking your bank or family is much cheaper. Smarter alternatives for payday loans include things such as line of credit. Interest rate on line of credit is usually 8 to 12%. Credit cards. Still expensive, but far cheaper than payday loans. Community programs or credit unions. Some offer low-interest emergency loans. Payday loans are designed to look like a quick fix, but in reality, they're a financial trap that keeps you stuck. If you've ever thought of taking one, pause and look for other options first. And if you've used them before, you know how painful they can be. So what do you think? Should payday loans be banned completely, or do they have a place for emergencies? Let me know in the comments. And don't forget to like, share, and subscribe for more personal finance tips that actually help you build wealth, not destroy it.